All right, so welcome to, gosh, I don't know, we've done a lot of these webinars now over the years. I'm not sure what number this one would be, but 2022 year-end tax planning, one of our favorite topics to discuss. And we're wrapping up most of all the year-end tax planning for our existing clients. And so it's just kind of a fun topic to share and share some good information. I think this is one of the tax planning, many times a number of opportunities that sometimes people don't maybe know about at times. So just being aware of some options that might be out there, and we have a fun mix of just looking at the participants, the attendees here today, fun mix of people we work with that you just want to keep learning more, and some people we don't work with. And so we appreciate you showing up today. And just before we dig in, we're excited to, we've got another Oceanside Client Appreciation event coming up here the first weekend of December. All right, so if you have not RSVP'd yet, Friday, December the 2nd, or Saturday, it's the 3rd, you could let us know. We're just trying to get tickets squared away and determine how much food we need to order, things like that. Outside of that, obviously Patrick Gall also on the call with us here today.
Yeah, if anyone's having any trouble hearing, I get to wear the IT hat in the office. So if anyone's having any difficulties, just send a quick email to info@oceansideadvisors.com. I'll be tracking that throughout the webinar. And then you should see down towards the bottom of the page a little Q&A button. We'll take a little bit of time towards the end of this to answer any questions, whether something wasn't clear or something a little more specific might pertain to your situation. Just fire those in there and I'll kind of gather those as the webinar moves along. That's all I got.
Perfect. Quick disclaimer, through this webinar, Oceanside Advisors does not render or offer to render personalized investment or tax advice. Information provided is for educational purposes only and does not constitute financial, tax, or legal advice. Really important, okay, especially with taxes. Everything that we go over today, there are so many little caveats that are beyond the scope of the general ideas we're going to be going over today, that it's of the utmost importance that before you take action in your own financial plan, that you are consulting with other professionals on specifically on the tax side. Everything we're going over today here, before we do it, for our clients, we are collaborating and bouncing ideas off of their CPAs, accountants, and very important that you do the same. So, all right, so our goals today. First off is just understanding tax planning strategies available for individuals and families for 2022. I think it's important we start. So similar to last year when we did this, it's before we get into some strategies, I think it's important to you need to understand like how the basics of how taxes are calculated. All right, so we're gonna again, I'm gonna do my best just on just using one slide. It's just a crash course on how taxes are calculated. Next, we'll go over some specific tax items for 2022. Then we will discuss some ways that you might be able to reduce taxable income this year. And then some might be surprised to see why we would have a bullet point, how can I increase my taxable income this year? We'll go over some reasons why in some cases you might want to do that. So that's our agenda for today. All right, so starting off, how are my taxes calculated? Okay, so this is my best effort at a one slide how taxes are calculated. All right, so obviously you start with gross income. All right, so gross income, that's going to include W-2s, maybe a 1099 if you're a contractor, right? Any kind of Social Security, pensions. If you're self-employed, you might have like a K-1. But basically all income gets thrown in at the top in some kind of way. After that, we're going to subtract from your gross income deductions for AGI, adjusted gross income is what that stands for. Okay, so the items here we're looking at, IRA, health savings account contributions, possible student loan interest depending on income. And so gross income minus deductions for AGI gives us the all-important adjusted gross income. Again, I've got a couple of stars by adjusted gross income because this is a really important number. It's not your taxable income, but why adjusted gross income is important is because this is what determines certain credits that you may or may not qualify for. This is the number that determines can you contribute to a Roth IRA or not. This is the number that your medical, okay, we'll get into itemized deductions in a bit, but depending on this number, it can very well influence whether or not you'll be able to deduct medical expenses or not. All right, so adjusted gross income, really, really important. From there, once you have adjusted gross income, we subtract the larger of a standard deduction or an itemized deduction. Okay, so you can't do both. It is whichever is larger. All right, so standard deduction, everyone has this. Okay, so at a minimum, everyone's going to have this. For 2022, if you're filing single, $12,950. If you're married filing jointly, that standard deduction is $25,900. All right, now if you've reached that fund Medicare age of 65 or older, you also get an additional $1,400 per person. All right, so if you have a couple married filing jointly and both spouses have obtained the age of 65 years old, your standard deduction would therefore be $28,700. Okay, so that's the standard deduction. Now, itemized deduction, okay, is going to be the sum, and there's a couple others, but these are the four main ones. The sum of these four components. So mortgage interest, right? So if you have a mortgage, the interest that you paid throughout the year will be included in your itemized deduction. Okay, medical expenses in excess of 7.5% of your adjusted gross income. So again, you can see there why your adjusted gross income matters so much, right? If you have, for example, adjusted gross income of $100,000, that would mean that you would get to deduct medical expenses, anything that costs more than $7,500, right? Whereas let's say adjusted gross income instead is $200,000. Well, then you're going to need 15,000. In excess of 15,000 before you can even start deducting medical expenses. So medical expenses in excess of 7.5% of adjusted gross income. You then have state and local taxes. Okay, so property taxes, income taxes. You have what's called the SALT cap, where the most that you can deduct on this third piece right here is $10,000 per year at the moment. Okay. There's definitely some bickering and a little tug of war in Congress over that $10,000 cap, but as of now, that's where it stands. Lastly, charitable contributions. All right, so if the sum of these four itemized deductions does not exceed your standard, then basically all these itemized deductions from a tax standpoint do not matter. Okay, so just important to understand the way that works. So gross income minus deductions for AGI, you land on your adjusted gross income. You then subtract either the standard or the itemized, and this is going to give us the line item taxable income. All right, from there, you look at your taxable income. There's a schedule, okay, depending on where you fall in the tax brackets. You'll see a number that, okay, this is the tax that we owe throughout the year. Okay, not done yet. Once you have taxable income, now we get to subtract any tax credits. Credits are different than a deduction, so a credit's going to come after we have that taxable income. So we're going to subtract eligible tax credits. These can be things from child tax credits. You know, they have these solar credits, child dependent care credit. If you're taking care of an elderly mom or dad or someone disabled, or educational tax, there are all kind of credits, many more than are even listed here. But once you subtract your eligible tax credits, then you'll look at, okay, did my withholdings throughout the year from my paychecks or my RMDs, did I withhold enough, right? And this is where, towards the bottom of the 1040, it's, well, you're either getting a credit back or we got to send Uncle Sam a little bit more money. So I hope this was helpful. Yeah, just kind of one page crash course here, but that's how taxes are calculated. Very, in a very simple manner. All right, so a couple other just basics that we want to go over. In the United States, we have what's called a progressive tax code, simply meaning the more money you make, moving from left to right, the higher tax rate you pay. All right, so very important to see, to kind of know where you sit. All right, so we like these tax maps because when we're looking at proactive tax planning, we want to be very cognizant and aware of where particular client sits in the tax map. And many times the most important tax planning opportunities arise right at these breakpoints, right? So from a 24 to 32% marginal tax rate. We want to make sure if we have the opportunity that we can avoid, a lot of these breakpoints. Many people don't understand that, long-term capital gains and qualified dividends it's actually a totally different map. Okay, so these are taxed quite differently from ordinary income, like earned income. So you have a big, 0%. And this is what we'll talk about this a little later, but many people don't realize that there's actually a 0% tax rate up to a certain amount of income, and many times you can fill up capital gains at a 0% tax rate, and a lot of people, they might hold a position that they might not otherwise, they might not love a certain investment position, and they hold it thinking that they'd have to pay taxes on it when. Maybe in a certain year when income is lower, you might be able to recognize, sell some of that position at a 0% tax. Okay, and then it jumps to 15 and 20. There's a little bit more involved here. There's also what's called the net investment income tax, which is an additional 3.8% tax to fund the Affordable Care Act, the Obamacare. So, but this is kind of the simple tax map. All right, so now that we kind of have the basics out of the way, just a couple specific items for 2022 and just some changes from and just some things to clarify. All right, so for one, required minimum distributions. All right, so RMD for short, for personal IRAs are required. All right, so if you recall, during the COVID pandemic, they passed the COVID Relief Act, which temporarily suspended RMDs, right? So you didn't have to take them. Now you had to this year, and so we just want to be clear, like that's still the case for your own personal IRAs, 401ks as well. Like if you still have money in a 401k, 403b, RMDs are required. Really important. Inherited IRAs. Okay, so a little different from personal. Inherited IRAs that you inherited prior to the Secure Act, so pre 2019. So you've already been taking the RMDs based on your that the lifetime table based on your remaining lifetime, those RMDs are also still required. Okay, so your own RMDs for your own personal accounts, they're going to be required. If you have inherited an IRA, prior to the Secure Act, those RMDs are also still required. The tricky one is this one, okay, and this is really, this has been a gray area really since they put it together, and we're still getting clarification on this, the way this is going to play out in future years. But inherited IRA, if you've inherited an IRA post Secure Act, right? So just in the last couple of years, and you're subject to the new 10-year rules. Okay, if that's okay for this year, you are not required to have an RMD. Okay, it's looking like in 2023 you will, but throughout the rest of this year you don't have to worry about taking an RMD. Okay, the other notable change, just to make people aware of, last year in 2021, they had a $300 per person or $600 if you're married filing jointly, where you could receive an above the line, meaning like before adjusted gross income, above the line charitable deduction, even if you're taking the standard deduction. Okay, so they let you have this deduction in addition to your standard deduction. Okay, so as of now, this could change, but as of now, that deduction has not been extended. Okay, so in other words, it's looking like for 2022, only taxpayers who itemize will receive any kind of charitable deduction, right? Because thinking back to our crash course slide, right, a charitable deduction that falls in one of the four main itemized deductions. Okay, so just be aware of that. Who knows, that they could change it. Again, they could extend that, but I have not seen everything I've looked at. It looks like that will no longer be available for taxpayers that are filing the standard deduction.
Johann, before we get too far away from the RMDs, slide we were just chatting about there, do you want to touch briefly on just who, for a personal IRA, what an RMD is, and who's required to take one? Good.
Yep. and this is when we do this webinar again at the end of next year, like we very well could have different rules again. But yes, so if you are turning 72, or if you turn 72 in this calendar year, okay, so in 2022, if you have turned 72, or you have already, or you're older than that, you are required to take an RMD, right? So that number used to be 70 and a half, and then as part of the Secure Act, that jumped to 72. There are bills in the works where that number very well could get increased to 73 or 74, 75 in the years to come. But as it stands today, if you've already turned 72, or you will be in the next month and a half, you're going to want to make sure that you take out that required distribution out of your pre-tax accounts. The IRS, it's a pretty nasty penalty in the tax code, right? So if you fail to take out your RMD, it's a 50% penalty. So you want to make sure that you're consulting with a tax professional, other professionals, make sure that you're taking out the proper amount. Thanks, Patrick. Okay, so next slide. Why might I want to reduce taxable income in 2022? There's a whole list of reasons, and we'll just go over a couple of the main ones. All right, so for some people, once you've started Medicare, age 65, there are certain thresholds where your Medicare becomes more expensive, right? So your Part B and your Part D, this is based on something called IRMA. Okay, so if you're near one of the breakpoints, reducing income in some fashion could reduce your Medicare premiums, the amount that you pay in for your Part B and your Part D. For those of you that haven't reached age 65 and you're qualifying for a subsidy through the Affordable Care Act marketplace, reducing your income in some way very well could potentially reduce, increase your subsidy, which would reduce your out-of-pocket expense for that plan. All right, pay less on Social Security income. This is a little bit outside of the scope of this webinar, but if you go to our website and you look at, I believe it was webinar number 3 called Taxes in Retirement, the way Social Security tax is really interesting, and it's based on your other income. Okay, so many times if you can reduce your other income through, whether it's less withdrawals or you're contributing to, a retirement account if you're still working, many times you can reduce the tax that's due on your Social Security. All right, so that'd be another reason. All right. Roth IRA contributions, again, whether you can contribute or not is dependent on that adjusted gross income number. So for some people, and we've had a handful of clients this year where this has been the case, if we can find a way to reduce adjusted gross income below the thresholds, that can be the difference of being eligible to contribute to a Roth IRA or not. Kind of along the same lines, this is also dependent on other factors, but you might be able to deduct a traditional IRA contribution. You might be able to avoid the 3.8% net investment income tax, and most obviously pay less in taxes, right? So, and that kind of gets to some of the breakpoints, the marginal tax rate. So if we can kind of avoid those breakpoints and push income out of the higher thresholds, we're going to pay less in taxes. So, all right. So if these are some reasons why a taxpayer might reduce taxable income, let's talk about some ways that we can accomplish that. All right. So for one, if you're still working, contributing to retirement plans. Okay, and to be more specific, into pre-tax retirement plans. All right, so that could be 401ks, 403bs, 457s, TSP if you're a government employee, traditional IRA, a SEP IRA. I could also add a simple IRA on here if you're self-employed. So a lot of different pre-tax accounts that you can contribute to reduce your income in a particular year. All right, if you are on a high deductible healthcare plan, contributing to a health savings account, right? So an HSA will, and to be more clear, that this is if your employer is contributing, that's not going to count. But if many times, like an employer will put some in, and you can add more on top of that into an HSA up to a limit, your contributions will likely reduce your income. All right, you have the option to contribute to 529 plans for kids, grandkids. Important to point out this distinction, that this is only a state income tax deduction, okay? And to go even a step further, not all states have that deduction. So most of our viewers here are going to be South Carolina, where you do receive state income tax deduction, but certainly check with the CPAs, the accountants in your state for your particular situation. Another means of reducing taxable income, tax loss harvesting taxable accounts. We'll touch more on this later, but especially in a market year where the market's down a little bit here, if you have a taxable account, this opportunity is likely available to you. So we're going to dedicate a whole slide and kind of an example of how tax loss harvesting works. Okay. Improve the long-term tax efficiency. So this is what we are not going to have an additional slide on this, but especially with the market year that we've had with markets down, if you haven't taken a good hard look at any kind of legacy mutual funds that you might have in your account, this is definitely a good time to do it. Okay, so the industry's just come really far in recent years, where if we just back up even 10 years. Really the only way to have a nice diversified portfolio, that the primary tool is mutual funds, and mutual funds have a lot of benefits that we like. One of the shortcomings of mutual funds is they have what's called capital gains distributions. Okay, where at the end of the year, depending upon the activity within the mutual fund, they spit out a capital gains distribution, which ends up going on your return, so given that, so the industry's just made great strides where now some of the mutual funds that they're available in an exchange traded fund format, so an ETF format, which is typically most of the time much more tax efficient. So just long term, not just for this year but future years, taking a good hard look at mutual funds and whether or not they still belong in your portfolio, in the taxable accounts, that is, would be a really good step. We will also have a slide on the strategy bunching your itemized deductions, which can be really helpful for some, and also the use of qualified charitable distributions from retirement accounts, from IRAs, QCDs for short. So, and we'll also have a slide on that one. Okay, so first we're going to look at tax loss harvesting. All right, so taxpayers can deduct up to $3,000 a year in capital losses in non-qualified, so in taxable accounts. And it's really nice because you can actually use this $3,000 to offset any kind of ordinary income, right? So this can be really helpful for many people, especially if you're on like a threshold of paying less in Medicare or Affordable Care Act. Sometimes this $3,000 can make a big difference. All right, importantly, you have to realize you have to sell a loser to receive the tax treatment. Okay, so just a very hypothetical example. I just wrote down a bunch of random letters. These are not real funds by any means. So yeah, let's say you sign into your account, and after a down year like this year, you might have some unrealized gains or losses in the account, right? So when you have a position that's down, right? So when the market's down, all right, if you don't do anything, okay, you're just going to have a down account, a down market, right? So one of the things that you can proactively do, this is something that we do on our end for all clients, but we take a look at any taxable accounts. And so, this hypothetical example, for this client, we'd look to be like, ooh, this fund, IJDX, this is a loser. Okay, this is down since we purchased it, right? So what we would do in this case is we'd want to sell that position. Now, really important, and I didn't do a good enough job clarifying this the last time we went over this. Okay, we want to sell this position, but we want to immediately buy a similar position. Okay, it can't be identical, but we want to immediately replace it with a similar position, because a lot of evidence, like, you can't time market successfully. So like we always want to be in the market, right? We don't want to sell something and then go to cash, and then the market bottoms and it goes 10% higher, and we have cash sitting on the sidelines. So that's not what we're saying. What we're saying is we want to sell this IJDX position so we can realize the loss on paper, right? So we get to realize the loss on paper that'll show up on the 1099 after the new year. We're going to buy an identical position, or we're going to buy a similar position, not identical. If you buy the same position back, you get disqualified. It's called a wash sale. So we're not going to buy back an identical position. We just want to buy a nice substitute with those proceeds. And then the way it plays out, so this taxpayer, you see it's a $3,500 loss. So this taxpayer would receive a $3,000 deduction for 2022. And then what's nice, that additional loss above, in addition, in excess of the 3,000, so that 590, that's going to carry forward into the 2023 tax year, right? So you can build that up, and that's shown on your Schedule D, right? So That's the way tax loss harvesting works. Patrick, you want to add something onto that?
Yeah, just a really important point. The above the line deduction there, and obviously I know Johan knows this, but whether you're itemizing or taking the standard deduction, you're going to get that deduction. So it being above the line means that it's happening before you make the decision to itemize or take the standard deduction. And then second point, that capital loss carryover, federal carryover. Most states let you carry it over. Some states do not. Just worth pointing out.
Yeah, perfect. All right. Bunching itemized deductions. Okay, so again, you only get the higher of the standard. You only get to take one or the other. Okay. Now, if you recall, prior to the Tax Cuts and Jobs Act, the standard deduction was much lower. Okay, so one of the biggest benefits that really helped the vast majority of taxpayers was that higher standard deduction. Okay, but given the standard deduction is so much higher now, it's estimated that only 12% of taxpayers now itemize. Okay, so again, what that means is for many people, all the primary itemized deductions, you're never ever going to have enough itemized deductions where you get credit for it. So here's another hypothetical example just to kind of show the way this works, and a strategy that we use for some of our clients that this makes sense for. Okay, so here we have someone. Okay, so let's call it Bob and Sue. Mortgage interest $10,000. Their property taxes $3,000. Those of you that don't live in South Carolina would be, yeah. I know we have some clients that come down from New York, New Jersey. 3,000 property tax. Like, yeah, that's actually a pretty nice home. Maybe a $700,000-800,000 home here in South Carolina. But so mortgage interest, property taxes $3,000. Let's say you don't have enough medical expenses to reach the 7.5% of AGI, and then let's say maybe your tithe is to the church $12,000 for the year. Okay, so in this case, Bob and Sue, the sum of their itemized deductions, $25,000. That isn't as high the standard deduction, right? So therefore, from a tax standpoint, they are receiving no benefit whatsoever from the charitable contributions or any of this. Okay, so a strategy that we can use is called bunching itemized deductions. This is 100% legal. You definitely want to do it the right way. But the way this could play out, and this works particularly well if your itemized deductions are close to your standard deduction, that this can be a huge benefit. All right, so instead, why don't we pay 2 years worth of property taxes and 2 years of charitable contributions in a single year? Okay, so what I mean by this is, like here in South Carolina, like we get our property tax bill in October. All right, so we receive it in October, but if you actually look at the bill, it's not due till January 15th. All right, so what you can do is you can hang on to that bill, not pay it until after the new year, right? And that way you can pay in January, you can pay the first $3,000, and then when you get the bill in October, then you pay the $3,000 again. So in other words, you're bunching both $3,000 bills into a single year. So now you have $6,000 worth of property taxes being paid in a single year. Okay. And then the other thing you can do is, hey, maybe if we're giving to the church $12,000 a year, let's just front load it all into a single year as well, right? So instead of giving 12 and 12, like let's give 24,000 all in the same year that we're paying the 6,000 in property taxes, and then the following year we won't be making a payment, right? So we're bunching property taxes and charitable contributions all into the same year. All right, so now look at how this changes. So now mortgage interest remains the same. We've got 6,000 in property taxes, Now we have 24,000 in charitable contributions. Well, now all of a sudden our total itemized deductions are $40,000, which we know now is in excess. It is more than the standard deduction, right? So that's going to be a huge. So yeah, that's going to end up being another $12,000 of deductions than you otherwise would have had. And then, the following year, Bob and Sue are just going to go back to the standard deduction, right? So the following year, you're still going to have the mortgage interest that you're not going to get credit for. But then in terms of property taxes, charitable contributions, those aren't going to be there. And you're still going to get the $28,700 deduction that following year. So that's the way itemized deductions work. Can be a huge tax savings for people. A common question that we receive here in the office. We even have some advisors in the office that may or may not do this as well. Okay, qualified charitable distributions. All right, so the way qualified charitable distributions work, first of all, you have to be at least 70 and a half years old. They can be a wonderful tax planning tool. The way QCDs, that's what we call them for short here in the office. This is where you give funds directly from your IRA to a qualified charity. Okay, importantly, like you can't touch it. All right, so and we've seen people make this mistake before, where they think, okay, I'm going to take a distribution from my IRA into my personal account, and then I'm going to write the check from my personal account to the charity. That doesn't work. That your QCD would be that well, it's not even called a QCD if you do it that way. That's just a gift. So in order for it to be a qualified charitable distribution, you need to write the check directly from your IRA. So with our clients here, like that, they have checkbooks for their IRAs where you once you're 70 and a half years old, you write the check directly from your IRA and you send it to the charity. This helps out for a couple of reasons. First of all, if you are RMD age, so if you are 72 or older, this QCD counts towards your RMD, and it's not included in gross income. So you can really, the old saying, you kill two birds with one stone, like that really is the case with QCDs. And importantly, like, so if you take the standard deduction, again, as we went over, like for many people, their charitable distributions, you're not getting credit for it because of the standard deduction. So maybe if you're not a great candidate for bunching itemized deductions like we just touched on, so even with a standard deduction, QCDs, you're effectively getting credit for it because up on the 1040, there's two different boxes. It says IRA distributions and then the taxable distributions. And the QCD, doesn't get included on the taxable amount. So you're fulfilling you're satisfying the RMD, but even in that, it's not being counted towards taxable income. So a really, really nice tool for those that are charitably inclined and have IRAs. Did I forget anything on that, Patrick?
Just one really important point. The TD Ameritrade, Charles Schwab, or whoever's sending the 1099 doesn't necessarily know that that money that went to the charity was a 501c3, or there are actually a couple others that this works for. But so we send kind of a tax planning letter at the beginning of every year with what portion of a client's QCDs were, or excuse me, IRA distributions were QCDs. So the CPA knows, so-and-so made a $3,000 donation to their church directly from their IRA. Make sure that when you go to do the 1040, you exactly what Johann said, the taxable portion and the full distribution amount, that those numbers are lining up correctly. That's the only thought that I had there.
Yeah, a really important one too. And that's one of the most common mistakes we see, by the way. And one of the reasons why for all of our clients, we like to see tax returns to double check a number of things. But That's one of them, particularly if someone is implementing QCDs, because yeah, to Patrick's point, like the 1099 that you're going to receive from the custodian is going to look the exact same. Like they don't have a different line that says you did it. Therefore, it's your responsibility to communicate that in some kind of way to your accountant. And so we send that that letter in January to all of our clients that we hope they give their CPAs to make sure this gets reported correctly. But yeah, great point, Patrick. Okay. Why might I want to increase taxable income in 2022? Some people get taken back when we say this, but quite simply, if you're ever in a situation where you're in a lower tax bracket this year than you think you will be in future years, this is something to consider, okay? Particularly for retirees. So where we see this many times is someone's getting closer to retirement, and they are in their highest earning years, and they're paying a really high tax rate, and they're deferring into 401ks and IRA, all the things you're supposed to be doing. And then what happens is all of a sudden you retire, and you're because you don't have earned income anymore, or not very much of it, your tax bracket might go from, well in the 30s to, like we see sometimes, it goes to 0. Okay. And you very well might have like this window of 1 year or 5 years or 10 years, like before your RMDs start. Maybe you haven't started Social Security as well, where you're just kind of in this lower tax bracket for whatever reason. And for many people, like that's a really nice year to start recognizing more taxable income while you're in these low tax brackets. You might be in a 0% or a 12%, and paying some of those taxes earlier, like when you're in a lower bracket, to avoid paying higher taxes later in life, right? Like once the IRS starts forcing your hand with RMDs at age 72, then you're kind of stuck, right, with Social Security and RMDs. If you're in a lower tax bracket, hey, like that might be a decent time to start moving money over to the Roth side, or getting money out of a traditional IRA or 401k. The other for some of our younger professionals, the other time this might make sense is if you happen to be like laid off in a certain year. Maybe you didn't, or if you're self-employed, maybe you have a year where you've earned less than you're accustomed to. Maybe you just have a year you're in a lower tax bracket, and that would also be a great time to, hey, like maybe let's move some money over to the after tax side, right? So very important, this warning. There are a ton of things that you need to consider and analyze before you accelerate more income into a certain year. Okay, for all the things we went over earlier, right? Like by doing so, if you started Social Security, like your Social Security could potentially get taxed at a higher rate. You could lose your Affordable Care Act subsidy. Your Medicare could become more expensive, right? Net investment income tax. So please, make sure that before you make a big decision like this, that you are consulting a tax professional to make sure you're not making a mistake that you might not be seeing. Patrick?
We had a question come in a little earlier here. I think this would be a good place to shimmy it in, just given it's relevant. Is when I start my Social Security important for taxes? I just feel like this is a pretty good place to answer that.
Yeah, great question. Who wrote that one in?
That was Bill.
Bill, great question. Yes. Like when you start your Social Security is a very important decision, and this is probably I think one of the more overlooked kind of mistakes that unfortunately we see retirees make. Again, so say you have really high earning years and then you retire, your tax rate goes to 0, and without giving it enough thought, someone might just start their Social Security not considering some of the other implications, right? Because to that question's point, like Social Security is a huge decision, right? By starting Social Security, you're going to start filling up those lower tax brackets, right? So many times, yeah, if you can defer it a year or 2 or 3, or push it all the way to 70, right, where Social Security maxes out, you create a larger window, a period of time where you can fill up these lower tax brackets with other income, right? So maybe taking money from a pre-tax 401k or a traditional IRA and moving it over to the Roth side. So great question. And absolutely, Social Security timing, you definitely want to give it a ton of consideration as it pertains to your overall retirement plan. Okay, so one of the ways in which we would accelerate income during a lower income year would be through Roth conversions. All right, so the way this works, and important to point out too, like Roth conversions, some people think when I say that means contributions, right? Like that's they're two very different things. So to contribute to a Roth, so a Roth contribution, like you need earned income. Okay, for a Roth conversion, that's not the case. Okay, so for conversion, you don't need earned income, right? So what we're doing is a Roth conversion. You transfer a very calculated amount of money from your traditional IRA to your Roth IRA. All right, so a lot of times we get the question like, can I only convert, right? Because the Roth contribution amount is $6,000 if you're younger than 50. It's $7,000 if you're 50 or older. So some people think you can only convert $7,000, and that's that's not the case. So for a Roth conversion, right, where we're moving money from traditional to a Roth, many times we look at someone's situation and work with their accountant, and we might convert when tax rates go to 0. We might convert 50,000. We might convert, I mean, we've done a few this year. It's well over 100,000 moving money from traditional IRA to the Roth IRA. And the reason for it, you can again, you're paying a lower tax rate today, but if you look out ahead, which I think I have a slide on this in a bit, you look out ahead, and if you have a large pre-tax balance, right, 401k or traditional IRA, like basically you have a ticking time bomb coming whenever that RMD starts, where the IRS is going to force your hand and you're going to have to start taking a bunch out. So the thought being with Roth conversion, hey, like let's pay taxes this year, right, at the lower rate. And therefore, the conversions are reducing the balance of your traditional IRA, right? Thus lowering future RMD amounts, which will be taxable. All right. So really, really important that you understand where you sit on the tax map before you do this. Again, for all the warnings we put on the last slide, like, you wouldn't want to convert an RMD and then, find out that your Social Security is getting taxed a bunch more. You just jump through 4 IRMA thresholds, and your Medicare went from $170 a month to $600. So you want to be very cognizant of your situation. But gosh, once the money gets to that Roth IRA side, it's going to enjoy tax-free interest, tax-free. The dividends don't get taxed. Your growth isn't taxed. Your withdrawals aren't taxed in the future. And then no RMDs, no required minimum distributions in the owner's lifetime. With the Secure Act now, inherited Roth, you do have to take some money out over, after 10, within the 10-year period, but that's outside of the scope. And then again, just make sure you're consulting with financial tax professional before completing any kind of Roth conversion. All right, so harvesting long-term capital gains, right? Many times at a 0% rate. And I know we showed this slide at the very beginning today, but many investors, there's this nice 10% tax rate down here for long-term capital gains. So if you ever experience, again, for all the same reason I just mentioned, maybe if you're a younger professional, you happen to get laid off, or maybe you just retire, you're in a lower tax bracket, and you might have and where we've seen this in our office is someone might start working with us, and they might have like a single stock, right, that maybe they've owned for years, right, and it's maybe the company's done well, and there might be a large gain on the stock, but coming into retirement, just from a risk perspective, it doesn't make sense to have that company specific risk, like that size of a position during retirement. So we might go and fill up some of these lower long-term capital gains brackets in order to better diversify the portfolio going forward. And again, I just want to keep putting these warnings, for all these, anytime we're accelerating more income in, it's so easy to make a mistake that just be really, really careful. Patrick?
Back to Bill's question about Social Security and taxes. This is a really good example of a place where deferring Social Security a little bit so you can realize a capital gain rather than filling up, if you have a $40,000 Social Security benefit, and your spouse is taking half of that, so you have $60,000 in Social Security coming in, you just ate up a big chunk of this. I'm circling it on my screen, no one can see that, but a big chunk of that 0% bracket.
Yeah, great point. Great point. All right. So we hope some of these ideas, maybe some thought-provoking ideas for many of you. For those of you that are clients, particularly retirement clients, a lot of this will look pretty familiar with kind of the tax maps and the way that we project things in retirement. And we're just getting done wrapping up all of our year-end tax planning for existing clients. So if for those of you that don't currently work with us, if you would like to visit with us about a couple of these ideas, we'd be happy to try to point you in the right direction, or just have a conversation to help you maybe think about some ideas and so forth. So if that's you, feel free to send us an email, info@oceansideadvisors.com. We'd be happy to set up a call or have you come to the office. Yes, I think we got a couple minutes for questions here.
Yeah, not surprising. We got a bunch of solid questions that came in about a super simple topic like tax planning. We have Arthur wants to know if you can touch a little deeper on capital gains distributions from mutual funds.
Yeah. And this is just such a huge one this year. We've seen it. So if we look at 2021, this is where a lot of people felt a lot of pain on this one. So in 2021, where the market did very well, if you recall. And what happens, like the way mutual funds are structured, again, there's a lot of benefits to owning mutual funds, but one of the shortcomings, the way they're taxed is all the activity like inside of the mutual fund. All right, so let's say, again, the fund did really, really well, let's say in 2021. And the fund managers, okay, so this isn't you like buying or selling, you're looking at your TD or your Schwab or your altruist screen, like this isn't you buying or selling. This is the mutual fund itself, like the manager that's deciding the positions inside of the mutual fund. Well, when the market has a really good year, and depending on the strategy, right? So some mutual funds are much more tax efficient than others, but inside of that mutual fund, that fund manager, if they're recognizing gains, right? So they might be taking profits or whatever the strategy is in that year. So you could own the fund, the whole calendar year and not sell it at all. Like you didn't touch it at all on your end as the end investor. But because the fund manager that's managing that mutual fund, all those gains inside of the fund are going to pass through to you in the form of what's called a capital gains distribution, right? So this is different in like the, the tax loss harvesting that we brought up earlier. Like this is totally different. This is nothing you have control over other than, owning a mutual fund that maybe isn't that efficient. So the problem is that capital gain distribution gets thrown on your Schedule D as if, you mistakenly sold a $20,000 gain position. There are some fund providers that are, we won't say names, Patrick. I mean, there are some that are really, really bad at this that we saw, just something we really want to try to avoid, right? So why I bring this up and why like this year in particular might be a good year to consider making changes, with the market being down. Okay, you might have these legacy mutual funds where, the capital gains distribution, they're just going to keep coming, year after year. Some years they'll be bigger than others, but while the ball's kind of in your court, maybe those positions are down a little bit this year. Potentially selling a position like that, and even if you have to realize like a little capital gain on your end for selling the fund, it might be in your best interest. Definitely something just to consider. If you just look beyond like this year, just look, many years out and what these capital gains distributions might be over the next 10 or 20 or 30 years. Like it might make sense. Hey, like maybe you sell half the fund in this calendar year, maybe half next year, or you start breaking, just have a plan in place because, even 10 years ago, and I know I mentioned this earlier, like you had to own mutual funds as the best way to have a globally diversified portfolio. Now you can use much more tax efficient ETFs, so exchange traded funds with with the strategies that we like, right? I know this webinar has nothing to do with investment philosophy, but there's a lot of options with very tax efficient ETFs that are worth considering if you own, if you want to take a step in the more tax efficient direction.
Solid answer. 3 more questions. I'm going to take 2. I'll give you this one and then I'll fire through the last 2. Jennifer wants to know, can stock options impact my year-end tax planning?
Oh yeah, big time. And stock options, definitely we help a number of younger professionals that have stock options. Most of the time they're through RSUs, restricted stock units these days. But for all the same reasons, when those RSUs vest and they become ordinary income, like you want to know when they're vesting, because that ordinary income is showing up in your income for that year, and that will absolutely have tax implications for everything else you're doing. So, and whoever wrote that, like, if you need help with that, contact us. But
but one other point with that too is, if you're someone that has RSUs, and I'm not going to go too deep into how they work, but if they've been investing, and your company's been doing well, you might have a pretty sizable tax, like capital gain on those positions. Mm-hmm. This could be a good year to, given that, and I don't know what company Jennifer's at, but if you're in a situation like that, this could be a good year to realize that capital gain, given that it might be lower than it would have been, a year ago maybe, and diversify out. We have an anonymous attendee asked, does a qualified distribution from an RMD also count for a charitable distribution for itemized deductions? And these 2 questions are the ones I was going to take because they're both charity related. Really good question. It does not. So kind of back to Johann's point earlier about how when an above the line deduction is what you're getting with the QCD. So a portion of your IRA distribution is not going to be taxable on your 1040 above the line. Whereas, which is why they're awesome. So they're not, whether you're going to be itemizing or taking the standard deduction, you get to send that money to said charity tax-free, and then continue to get the standard deduction on top of that, which is an awesome benefit. And then the other one, and I wanted to answer this one because I feel like this is from Becky. I don't know if you and my wife had a conversation, but we were discussing bunching deductions. The question was, could tax bunching be harmful to the charitable organization that a person donates to? And the example, or in other words, a large giving year and then a low giving year could be challenging for a church or other charitable community. Really good question. And I think that's going to be charity to charity based or church to church based. Because my wife had the same concern when I brought up the idea of bunching deductions. Two points on it. Depending on how you're giving to said charity, if it is a church and you are tithing, if you're giving 10% pre-tax or 10% post-tax, that's between you and the Lord. But I have two arguments for why itemizing, as my wife wanted to know, is going to greater benefit the kingdom. Point one is by receiving higher deductions in back-to-back years through bunching deductions. So if we're going to bunch them this year and then take the standard next year, we're going to ultimately raise our deduction. And because we're doing that, we're going to have more after-tax income to work with. Less of our income is being taxed, basically. So we will be able to give more to said church, given that we're doing 10%. Point two, like if I can convince my wife this year that it's a good idea for us to do, I'm just planning on writing a letter with it explaining that, you know, hey, we're kind of sending our tithe in for next year, so they're aware that you know, the Gall family isn't giving up on Christ. We're just, for tax purposes, waiting until the following year to contribute. And I would suggest doing the same if you're going to do that with any charity that you're that you generally give to on an annual or a recurring basis or monthly basis. Just letting them know that, hey, we're not going to forget about you next year, but we're giving for next year this year. So I don't know if that's going to convince my wife, but I got the whole PowerPoint drawn up for our Gall family finance meeting. Hopefully she bites, but we'll see.
Oh, that's great. Thanks for sharing that, Patrick. And we want to thank everyone else for tuning in today. And we wish you a happy Thanksgiving with your friends and family. And definitely reach out to us if you have questions, anything we can help with. Again, if you have not RSVP'd for our Client Appreciation Night, please do so. And we look forward to seeing everyone in a couple weeks. Thank you.